We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Oil prices, consumer spending. Are we headed for a recession? It's all about the pocketbook in today's Wallet Watch segment on Raw Naked Truth. I'm your host, Eric Lupkin, and I'm here with Chris Calandra of Elliott Wealth Management. And here's the news you need to know. Chris, welcome to our Wallet Watch segment.
Thanks for having me, Eric. I'm looking forward to our discussion.
It's always good having you. And we'll start off with over the weekend, Bloomberg came out with a survey saying that by first quarter of next year, most American consumers expect to cut their spending. Now, consumer spending has been a big boost to the economy. What happens when the consumer stops spending so much?
That's a good question, and it's going to relate to a really important topic regarding whether the U.S. is going to end up in a recession here over the next stretch. Let me just say, though, having been a financial planner, Eric, for over 30 years now, that I question the survey. Consumers, I think, will often say, yeah, they're going to cut spending because they kind of feel like they should. There's sort of the obligatory, let me say the right thing. I kind of want to cut spending. Seems like a good idea. It often doesn't materialize. Related to that, oftentimes you hear about, well, if the consumer stops spending, the economy is going to be sunk. But it rarely happens because the American consumer is a powerhouse of spending. So I question whether that'll actually happen because they're talking about first quarter. And I think the consumer is not lying when they answer the survey, but their behavior might actually not materialize. But on to the more important part of what you asked about, and you accurately depicted it. The U.S. economy is growing. We've avoided a recession so far on the fact that inflation has come down, and as you aptly described, consumer spending has been pretty strong. And you know this if you're listening to the Wallet Watch segment. You go out to a restaurant, your hotels, airlines. I mean, there are ample anecdotal signs that the consumer is out in force. But I do think come the beginning of next year that this recession that has been predicted for like 18 months now will actually arrive, and we'll have a recession in the early to mid part of next year. I don't know if it'll necessarily because the consumer spending is going down, but with the Fed raising interest rates as aggressively as they had, they'll probably tip the economy into a recession.
Yeah, that actually wouldn't surprise me. I mean, we've seen inflation growth slow, but
Yes.
we have not seen inflation actually go down. And that's been taking a toll on the consumer. And now we started seeing gas prices start creeping back up.
Yes.
And over the last few weeks, Saudi Arabia has cut production, Russia has cut production, and Biden took 13 million acres of oil producing land in Alaska off the market. In fact, canceling leases. So we've got a couple of things that are coming to a head over the next few months. We've still got inflation higher than the Fed wants. They've already said it looks like they're going to be raising rates again. We've got gas and oil prices going up, and that's especially going to hurt as we go into winter months. And on top of all of that, we've got the COVID savings dwindling. A lot of people got COVID stimulus they were able to put away. that's been a big factor in fueling consumer spending. That
That
savings is now dwindling. So with all of that going on, what's your impression?
Yeah, you and I are of the same mind, I think, as you described, coming out of the deepest part of the pandemic, Americans had amassed quite the little nest egg from stimulus they received from the government, from not being active and the stay-at-home phase. They had quite the cushion. And so they spent and worked off of that cushion over the last period of time, but now that has been exhausted, and there's ample evidence of this. And one example of that evidence is you now see debt going up because they've worked off the excess that they had built up, that cushion, that nest egg, and now they're fueling the spending more from debt than they had been over the more recent past. So with inflation coming down, it has been good, but a lot of it's been because of energy prices coming down from the peaks that were caused by both, I think, the Biden administration's policy as well as the geopolitical risks surrounding Russia's invasion of Ukraine. But food prices, cost of living, just to like live in your home, those prices are going up still faster than the mainline inflation number. So if you're listening to this, appreciate that inflation numbers take into account a number of different things in the economy, and some of them have come down, like I said, energy and car prices. So that's really helped the major number. But more stubbornly, things like food and stuff that you need to kind of keep your house afloat, not just food, but energy and that kind of thing, utilities, they've running faster than the mainline number. So the consumer is in a tough spot, and the Federal Reserve is committed to wrestling inflation under control. Like you said, they're probably going to raise interest rates one more time this year. What's interesting, Eric, though, is if you look at the Fed forecast for next year, they're forecasting that next year they're going to cut rates. And the expectation, the Fed has this, I forget what it's called, but this forecasting tool, and they're expecting 1% interest rates lower next year. So if it's 5.5 now, they're expecting 4.5, which is an indication that they're expecting an economic slowdown and probably a recession, and they'll have to reverse course to hopefully help the economy along. So it's really tricky, but I think listeners should expect that maybe this recession that's been talked about a lot over the last year and a half actually does occur. And I know you follow politics closely, Eric. You and I, in our past show experience, used to talk politics much more. It will be intriguing to see the presidential election unfold in the midst of this recession that we might be looking at in the early part of this year, because an incumbent party, an incumbent president really doesn't want to be running for re-election in a recession. That's tough sledding.
No, recessions never do well for the incumbency. And recent polls have said the economy is, for a large percentage of America, the number one issue that they're concerned about. So that's going to have some interesting political fallout. You mentioned car prices coming down, and I just want to get your impression on this. I don't know if it's going to have a big effect on the economy or not, but the big three American automakers have all reported that since the Biden administration has been pushing their green agenda and electric cars in particular, the car manufacturers now have a larger inventory of electric cars than they can sell. The American consumer doesn't seem to want this. What's this going to mean for the car manufacturers?
Yeah, that's a great question. And I think, and I mentioned politics a little bit before, but this is sort of a, my political philosophy will be revealed a little bit, but I think this is such a cautionary tale about corporations making economic decisions based on prevailing political winds as opposed to economic principles like supply and demand. And I think it was General Motors, that came out and lost a ton of money because of their investments in electric vehicles that have not paid off thus far. So there is a disconnect between what our leaders want in Washington, where they want to take the country, and where the country seems to want to go. I believe, Eric, that the leadership is right about the direction. I think, in my opinion, it's more about the speed of when we get there. And some of these car manufacturers have acquiesced, it seems to me, to the prevailing political winds, but they've done so at their own peril. And they've invested an awful lot in something whose time might not have come just yet. I think we'll get there as technology advances, but there's a lot that needs to take place. And I also think it relates to what you said before about the Biden administration canceling these oil leases. They have a hostility to fossil fuels, which I'm not necessarily opposed to. You can't, though, replace something with nothing. And that seems to be the political positioning, because these alternatives that all Americans should welcome and look forward to and would be an improvement for the environment, they're not necessarily there yet. So the transition needs to be smarter than I think our politicians are. They don't seem to be smartly negotiating through this changeover. So I think the car companies, the big three, General Motors, I know especially, I haven't done a deep dive into this, so I'm talking off the top of my head. They've made some massive investments in something that hasn't worked out just yet, and that puts them in a tough spot.
Yeah, GM reported that they lose money on every electric car they sell. So
Yes.
that's going to be difficult. I honestly don't think electric cars as they're being sold today are going to be where we end up. I think the electric cars as they are right now are going to be the equivalent of the compact fluorescent bulb that we had for a while and then moved on to something better. I honestly do believe that the ultimate future of the automobile is hydrogen fuel cells.
That could very well be.
They're much more efficient. The infrastructure is easier to build. And unlike electric cars, they don't need these huge batteries that we have to outsource and get minerals from China. So I think that industry is going to be in flux for quite a while. And that's actually going to be a problem for the car companies, because they're going to have to balance what they're building with what they're selling and the infrastructure that they'll ultimately need.
Yeah, that's well said. And let me add, Eric, and again, I haven't done a deep dive. I can't quote statistics on this. There's a lot of what's called corporate welfare out there, where businesses, again, are not making economic decisions based on the marketplace, but is heavily influenced by tax policy, subsidies, government handouts, that kind of thing. I'm talking about the corporate level now. And it seems to me that the US car industry is one of the chief beneficiaries of this corporate welfare. Again, I can't statistically back that up. This is just my opinion. And that is part of this issue that is hurting them, because the government put in a lot of incentives for them to do this. So they make the decision on the incentives, but it may not pay off even net of those incentives. And the incentives are also temporary. If we have a Republican administration, they may behave differently, and that might put these car companies in a bad way. So I don't really like this corporate welfare generally, and I think this might be an example of that.
Well said. Well, Chris, thanks for being on this Wallet Watch segment. It's always great to have you. And of course, that's the Raw Naked Truth. And you can catch every episode of the Raw Naked Truth at xvadio.com/podcasts, Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Audible, Amazon Music, and other platforms that respect freedom of speech. We'll see you next time.